A hedge fund of funds is one of the most powerful ways to build an investment firm without directly trading the markets yourself. Instead of running one strategy, you invest in multiple hedge funds and build a diversified portfolio of professional managers. Large institutional investors, family offices, and pension funds often allocate billions of dollars into fund of funds structures. In this video, I'm going to explain how to start a fund of funds and how the structure works, how managers are selected, and how investors get paid. Hey, it's Frank Nagy, and welcome to my channel where we help financial entrepreneurs grow their business in the financial markets. If you're new here, subscribe to my channel and hit that like button. A hedge fund of funds, often called an FOF, is an investment fund that allocates capital into multiple underlying hedge funds. Instead of trading stocks, forex, or derivatives directly, the fund manager focuses on selecting hedge fund managers, allocating capital across strategies, and managing risk and diversification. For example, a fund of funds portfolio might include a long-short equity hedge fund, a global macro fund, a quantitative trading fund, and credit strategy hedge fund. This creates diversification across strategy markets and managers. For investors, it provides professional manager selection and risk management. Most hedge fund of funds structures follow the same legal framework used by traditional hedge funds. The structure typically includes the fund entity, which is usually a limited partnership, which is in the US, or an offshore company, say the British Virgin Islands, and that's where the capital gets formed. And then there's a general partner responsible for operating the fund and the investor relations. And finally, the investment manager, the management company that makes the allocation decisions and manages a portfolio. Oftentimes, the general partner and the investment manager are one and the same. Hiring experienced hedge fund consultant like Frank Nagy Financial Services will greatly reduce the burden of setting up your hedge fund or fund of funds. A good hedge fund consultant will provide introductions to attorneys, banks, administrators, and other service providers that will help your hedge fund or fund of funds grow. The most important job in a hedge fund of funds is manager selection. Successful fund of funds spends enormous time performing due diligence. Managers also evaluate operational risk by reviewing auditors, administrators, compliance procedures, and trading systems. Institutional fund of funds firms may analyze hundreds of hedge funds before selecting only a few managers. The goal is to find strategies that complement each other and produce consistent long-term returns. Once managers are selected, the next step is portfolio construction. A diversified fund of funds may allocate capital across strategies like equity long-short, global macro, quantitative trading, event-driven, and credit strategies. For example, a simple allocation might look like 30% in a long-short equity, 25% in global macro, 20% in quant strategies, 15% in event-driven, and 10% in credit funds. This multi-strategy approach can help smooth volatility and reduce the risk compared to investing in one single hedge fund. Unlike traditional standalone funds, a fund of funds typically charges two layers of fees. First are the fees from the underlying hedge funds. Many hedge funds charge 2 and 20 structure, 2% annual management fee with assets under management and 20% performance fee. The fund of funds then charges its own management and performance fee for manager selection, portfolio construction, due diligence, and risk monitoring. Many fund of funds charge something closer to 1% management fee and a 5 to 10% performance fee. This structure compensates the firm for selecting and managing the portfolio of all the hedge funds. Fund of funds are popular with investors because they provide instant diversification. Typical investors include family offices, institutional investors, high net worth individuals, families, pension funds, and endowments. Many investors prefer allocating to a fund of funds because it gives them exposure to multiple hedge fund strategies in one portfolio. Starting a fund of funds is essentially about building a portfolio of great hedge fund managers. Success comes from strong due diligence, intelligent portfolio construction, disciplined risk management, and strong relationships with investors. When done correctly, a fund of funds can create a scalable alternative investment platform with access to one of the best hedge fund managers in the world. Hey, if you'd like to learn more about Frank Nagy Financial Services and how we can help you set up your fund of funds, hedge fund, or offshore broker-dealer, click on the links below in the description box.